Welcome to another episode of FINSHERPA videos. We are grateful for all the love and support that you have been pouring over the last few months. There is a war for talent that is going out there. The best of the brains are being solicited by every company for their own growth. And people want employees to stick with them for a reasonable period of time. Now, all these are challenging in an environment where there are lots of opportunities and people jump jobs at their whim. Now, that is where the employers or the companies need to come up with an option that can get the best brains to work for them and also stay with them for a reasonable period. That is where this concept of employee stock options comes into play. In the short, it's called ESOP. Now, today we're going to talk about what is ESOP and how to get the best out of ESOPs if you have that option. Now, ESOP, as it is called, is an agreement between the employer and employee of giving a certain amount of equity-related benefits to the employee for taking up the employment contract with that enterprise. It also stipulates that if that employee sticks around for a reasonable period of time, he will be able to unlock the equity valuation that has been allotted to him. So that's a very broad definition or explanation for ESOP. Let me break it down a little bit more. ESOP is an agreement wherein the company would use either equity or a derivative of equity to give an enhanced benefit to the employee so that he starts looking at that engagement in a much longer term with a more holistic view rather than more just as an employment contract. Now, to do this, the employer would typically give either equity stock or an option to be vested in that employee after a certain period of time. So, as an example, let's say I'm joining an enterprise today. The employer may say at the end of 24 months, you will vest with say 5,000 stock of the company. And then the ESOP would also say that 3 years down, you will be able to exercise that ESOP. And in any time in between, if you should leave the contract of employment, then you would lose the complete benefit in ESOP. So what is the company doing? It is kind of trying to marry your loyalty with the long-term growth of the enterprise. So what you would do is, if you carry on working for that company, at the end of this tenure of 2 years, in this example, you would be allowed by the company to subscribe to 5,000 stock. That is the vesting date. You will be allowed to buy that stock. Typically, these stocks are either given at face value or they're given at a discount to what is the market value or the perceived value. That is why the advantage comes. Now, between what the value of that stock is, there is a discount at which the employee is being offered. That's really the benefit that the employee enjoys on this. Now, from an income tax perspective, this is considered as a benefit that the employee gets. As a result, it is taxed in the year in which it is vested. As an example, let us say I'm allowed to subscribe to 5,000 shares at a value of 10 rupees each on the vesting date. And let us say for some reason that stock is valued at a price of 50 rupees as on that date, either in the stock market or maybe as a startup I get funding and the last funding closest to this date is valuing the company at 50 rupees. So whichever way it is, the employee is benefiting at the rate of 40 rupees per share. So 40 rupees into 5,000 gets added as a perquisite in that year for that employee for his personal taxation. So that's something that one needs to remember. Now, in this case, if the employee continues to hold this stock and continues to work with the firm at the end of third year, therefrom, as per the contract of ESOP, he can liquidate this investment. That is called an exercise date. As on the date of exercising, he can choose to liquidate the stock and encash it the way he wants. Now, that time between the 50 rupees that he is already paid for and the ultimate price that the stock goes out for or is valued in the market or whichever way it is, the amount will be taxed as capital gains in the hands of the investor on the date of him exercising that. So in the year he has exercised his option, he will have a capital gain liability to the extent of. There are broadly three types of ESOPs that are offered. One is, like I said, is called restricted stock units, RSUs as they are called. These will give you certain amount of stocks that the person can subscribe to in the form of a discounted price. It could be at face value or a significant discount. If you do subscribe at the vesting time, then at the time of exercising, you will get the benefit of being able to sell it and realize value and so on. There is also another option which is called a phantom stock option, which means that you don't actually give out the stock, but you give something that appears like a stock, but in turn is only a phantom option. It's not a real option. Here, the company doesn't suffer from stock dilution. It doesn't have new shareholders and so on and so forth. It's only a proxy to the share that is calculated. Very similarly, it's calculated. The idea is to generate and give the benefit, the financial benefit to the employee rather than actually the stock. The third is EPP, Equity Purchase Plan. And this is very popular with many of the MNCs which offer their overseas listed stock to their Indian employees. So here, very similar to the earlier option, you get to purchase the stock, a discounted price to the trading price in the market, and then after a certain period of holding, you can exercise your option to sell these and then realize. Again here, the intent is to make sure that you are compensated both for your loyalty as also in a form that is different from just paying salaries. So that is about ESOPs. What does ESOP do? How does ESOP benefit employee? As an employee, after a certain point, all the monies that I get is taxed at the highest rate. So it's no longer fun to collect a large paycheck where a large amount is taken by the income tax man. So I could actually choose to have a package in which a certain amount comes to me as salary, a certain amount comes as a kind of a stock option that I bet on the company in the long term. Second, I get to value my growth in the company's share price. So if I'm a hard-working guy, if I'm going to bring great value to the company, I'd like to stick on to the shares of the company so that along with the company, I can too benefit in the long term. So stock option is a great idea in cases like this where it benefits both. It's a win-win for both the employee and the company. Third, employee stock options have a great role in ensuring that I'm not distracted to look at other options, because I know that if I stay for a 5-year or an 8-year period as per the vesting and exercising options, I will make a bigger pie here than to look out for. So it helps the employee avoid a lot of distractions. And last but not the least, there is a big upside possible. Some of the largest Indian companies have benefited. Let's say when Flipkart got acquired by Walmart, many of the people holding their ESOPs in Flipkart, their early employers, benefited big time because the valuation had gone through the roof and they had benefited big time. So that's a great advantage, great way to create capital corpus for the employees. Now, how does ESOP benefit the employer? First up, if you're acquiring great talent in the market, you must be willing to pay a big price. But many new companies or the new age companies don't have that kind of luxury of paying big price. So they can afford to pay what they can pay, and the balance they can choose to give as an ESOP. It's a good way, a win-win for both. Second, ESOP help longevity of the client. Especially key people in the organization need to be staying with the organization long term if the company has to grow to the next level. ESOP plays a great role in helping that happen. Third, as the company grows, the employee also makes money, and employee also creates a loyalty band. So from that perspective, there is no immediate outflow for the company, and therefore the early profits of the company can be preserved for the long-term growth of the enterprise. Now the question comes is from an employee standpoint, when I encash my ESOP, when I exercise my option and I sell my stocks and realize my money, what is it that I should be doing? And it's extremely important that as investors, we plan this portion really well. First thing to do is in any of these plans is to determine what is your tax liability and therefore pay your tax liability on that immediately. Second, if I were getting these large payouts in the form of ESOP encashments, I would check my home loan and find out if it's a very costly and if it's a very large home loan, I try to kind of reduce it to the extent possible, if not pay it off entirely, especially if it's a costly one. If I have other loans like personal loan, others, I'd kind of definitely want to close that. Third, if all this is done and still I have money, then I have a near-term goal. Let's say I hit higher education in the next 3 years, 5 years. I would want to devote this money for that. Fourth option, after all this is done, I'd like to devote this money for my retirement plan. Because let's face it, this came because of my employment. So it's only fair that this money is directed towards my long-term retirement needs. So I think that's another great way to kind of secure one's retirement plans using the proceeds that you realize from your ESOPs. Especially for the IT companies, ESOP is a great model of attracting great talent. It's also a great tool for individuals to pick up and create long-term wealth. One caveat alone I'd like to leave behind. ESOPs are not very certain. The company has to perform at a certain level. It takes many years before these ESOP stocks realize value. So do not count your chickens before they hatch. So when you calculate your wealth, until you've exercised that option and realized money, do not count ESOP money as yours. It's a simple advice, and I think you will be wiser for it. Hope this was useful.